We're looking at a mixed market with just around 2 minutes left in the trading day. Dow, the only major average, on track to close in the green. We want to bring in our all-star panel. We have Keith Lerner, Chief Market Strategist with SunTrust, Greg Staples, Head of Fixed Income at DWS Group, and also our very own Jared Blikre. Keith, let me kick it over to you first. I know you've been bullish now for quite some time. How are you thinking about the market in light of the vaccine news we got yesterday and yesterday's massive rally?
Well, I think what we've seen over the last week is just a big release of tension, some less uncertainty on the COVID front as a whole, and some election uncertainty. And as you may recall, heading into the election, we were telling our clients to use the uncertainty to move into the market or to add to stocks. And we're still positive. I think on a short-term basis, we've had a really nice move here in the last week. We're up 8 or 9%. We've seen the average stock do much better, some rotation out of tech. I think we'll probably start to settle into more of a short-term range. But overall, as we look forward over the next 12 months or so, we're still very positive.
Greg, we have about 20 seconds to the bell. We'll pick it up on the other side. But you say this is the optimum outcome for the election. Can you give me 3 reasons why, very quickly?
Because you've got the White House with a little bit more stable in terms of trade policy. You've got presumably a red Senate. Your previous guest, notwithstanding, is probably the Republicans take Georgia, which will be a tempering effect. And you've got a House that's a little more moderate, so probably less in the way of higher corporate tax.
Green up 252 points, S&P and NASDAQ ending the day lower. Jared Blikre, I want to bring you in. You're looking at this rotation here that we've seen in the market over the last couple of days, continuing today, where we see a lot of those big tech names under pressure with the NASDAQ off more than 1%.
Yes, they have. And you can see the disparity just in the results of the major indices now. So we got the Dow up 260 points, not quite 1%. NASDAQ down 1.3%. S&P 500 just slightly underwater, 14 basis points. And the Russell 2000 knocking it out of the park again, up 1.86%. And you look at the 2-day price action in the Russell here, and actually let's go to a 7-day because that's how long this rally has really been going on since last Monday. 12.89%. This is going to be good for the best November, at least on track for the best November in the history of the Russell. And you'd have to go back to 2016 to see the second best. And I think that says a lot too. You talk about rotation. Yeah, we have nice internals right here. So the S&P 500 equal weighted has been advancing nicely. It was up 62 basis points today. We've got broad participation. You look at some of the market internals, like advanced decline lines. The S&P 500 closed at a record high in terms of breadth and advanced decline line. New York Stock Exchange might be there as well, might be tied. But nevertheless, we're seeing this rotation is inflicting a lot of pains on some of the portfolio managers and hedge funds and maybe individual investors. But this is what happens. Anybody who wants to participate in what usually happens at the end of the year in December and November, that's the melt-up rally, needs to get their ducks in a row right now with as much information as they can. And I think that's what's happening. So unfortunately, some of the big high flyers, Zoom, that's off another 9% today. You look over the last 2 days, 24%. That hurts, but we're seeing it make up in other areas. And I don't think this continues forever. We're going to have to see the big guys participate if we want to get to record highs and extend beyond. But it's been, when you have a breakout like this and then you come back and test a prior breakout level, as we've done today in the S&P 500, it's perfectly normal. And I'm not looking too negatively at this price action right now.
Jared, thank you. Greg, I want to bring you back in, and I put you on the spot. In 20 seconds, give me a dissertation, with the 3 reasons. But there was something you pointed out that has gotten lost in the election about some of the fundamentals that may help this market drive even higher as we go forward. And that was the jobs number last week. What does that tell you about what's going on in this recovery?
Adam, it's funny because it did get lost in the headlines, but the jobs number last Friday was an absolute blowout. 1 full percentage point decline in the unemployment rate. And the demographics were really strong as well. 1.3% decline in Black unemployment rate, 1.5% decline in the Hispanic employment rate. 2.2 million Americans got a job last month that they didn't have before. Ultimately, I think the market's going to be driving on an economic recovery. It's going to grow on earnings, and this sets the table for a nice recovery in 2021. So we're really pretty positive. And the amazing thing is it did it in the face of increasing COVID and also no stimulus. Everybody said the economy was going to slow down once the July supplemental unemployment fell off. It fell off, and we still did okay. Services and leisure, they gained 600,000 jobs in the last 2 months. So the momentum is pretty strong for 2021.
Keith, we just heard Greg mentioning the fact that we still don't have stimulus. What is the market expecting at this point? If we don't get some sort of deal over the next couple of months, could we expect to see a sell-off?
I think you might see some choppiness, but to the point is, I think people now don't realize that the economy can move forward, without stimulus, and it has. It won't be as fast as if we get the stimulus, but we still think a package is likely coming, and the market will look through that. And also, just seeing the end or the other side of this pandemic, I think will allow investors to look to the other side as well. So, again, I would really focus less on the next 3, 4, 5%. If we're early into this economic cycle, as you guys just discussed, which we think we are, we think we probably have multiple years to go. The underlying trend should be positive. And the earnings story is so underappreciated. We're seeing earnings rise at a very strong clip, the strongest since 2008. And on the other side of this, companies are going to be leaner, meaner, and we think profits rebound a lot quicker than people have anticipated. And so far, it has surprised to the upside, and we expect that to continue into 2021.
So for many years, we've all thought, tech. What other sectors besides tech? Because we're seeing money come out of tech right now. What other sectors should people then pay attention to going forward?
Yeah, well, one thing earlier this year, we were definitely more focused on just growth. We are more bullish now. We still like tech, but in the short term, we think it's going to continue to take a step back to places like industrials. Look at industrials today, making another relative high that we haven't seen in about 6 months. Materials sector is also acting very well. That's all good signs for the global economy. We've been underweight, financials for some time. We're starting to see improvement not only in price trends, but in earning trends as well. So we still have a bit of a barbell, but we're starting to inch more towards the cyclical side of that barbell exposure.
Hey, Greg, I want to ask you just about the 10-year, because right now we have yields rising once again, getting closer and closer to that 1% level. Is there a level that you're looking at where that the 10-year could hit, that then it gets a little bit worrisome for equities?
I think 1% is probably a good touch point. The point is, if it's done because of good, solid economic reasons, we can go through 1% and through that. If it's done more because of fear or some other reason, too much debt, then it's going to be an issue. Also, the reaction function from the Fed is pretty important. We think that they're willing to let the 10-year get above 10% without stepping in and doing some yield curve control. Again, if it's for the right reasons, nice jobless claims print, nice GDP print, et cetera. If it starts to rise with weaker economic data, they're going to step in and probably do a little yield curve control and press it back down below 1%.
When we take all of that into consideration, Greg, and I know you guys can't talk individual stock. I pulled one up, an industrial Caterpillar, which is actually, it was flat today at the close, but we're all expecting an infrastructure bill. Might not be as big as it would have been. We're expecting a stimulus bill. Might not be as big as it would have been with a split government. All that money is going to have to flow somewhere. So when we look at the sectors, I'm trying to find the argument as to why it wouldn't, industrials go higher and manufacturing go higher. And I can't find the argument right now that they won't.
I think Keith makes a pretty good point. I think that the previous stimulus, unfortunately, a lot of it was imported away. The people who got those supplemental paychecks went to Walmart and they bought stuff imported from China. I think a good infrastructure that's targeted can actually help the U.S. industry, help U.S. industrials. So that's a positive case.
Hey, Keith, we saw the market get so excited yesterday on the heels of that news that we got from Pfizer, but there's still lots of questions out there. There's uncertainty around the distribution of the vaccine, also some of those safety questions. We've been talking to doctors over the last couple of days who still have a lot of questions just about the efficacy and really getting the whole picture, I guess is a better way to put that. How do you expect the market to react if we do get anything that's a little bit worrisome on that front?
Well, I think to your point, we've had a nice upside move. You could see us give back some, but I think the other thing to remember is this isn't the only vaccine or therapeutic in the work. There will be others, and hopefully we'll get some more good news on that. But to your point, everyone's feeling really good. I know, when we added equities into the election, there was a lot of people thinking that we were somewhat crazy to do that because there was so much uncertainty. Now we're getting clarity. That means your expectations are a bit higher, so you could be set up for a little bit disappointment. But again, I think the underlying trends are still positive, and I wouldn't overly focus on the short-term hiccups, which are the admission price to being in the market. I would really focus on these broader trends, which in our view, for the economy, for the earnings, and for the market is still positive. And then just the last point, if rates move up, even if rates went above 1%, the equity risk premium, the earning yields compared to the 10-year Treasury is still in a bucket. When we test this out historically, where on a one-year basis, stocks have outperformed by fixed income by a wide margin.
So, Keith, we had a guest on last hour, Steve Sosnick, who pointed out that, so what if we go above 1% with the 10-year yield? But I did want to ask you, when you look in the rearview mirror and you point out that the S&P 500 has been up more than 10% over the past 6 days, since World War II, that's only happened 12 previous times. What is that telling you about where we're headed?
Well, the big picture, when you see kind of big momentum studies or big moves up in the market, that often scares people. And that might say that might mean the market's getting a bit stretched in the short term. But when you test these things out, they're actually very bullish when you look at 6 months to 12 months higher. And even like yesterday, we had 70% of stocks in the S&P make 1 month highs. Again, short term that often leads to a consolidation, but the risk reward when you look at 12 months is very positive as a whole. So I would say, don't fear momentum. Momentum historically is a good omen when you look at 6 to 12 months out.